Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Friday, July 31st, 2026. We're Elena and Marcus. This episode is brought to you by Bank Atlas, where the risk of every bank is quantified via proprietary grades and analysis. Learn more at bankatlas.com.
Right. Well, just to set the stage for everyone first, imagine, waking up to see $500 billion wiped from Apple's market cap in a single afternoon.
Yeah.
While Microsoft simultaneously adds that exact same amount. Today, we're looking at why the stock market just violently split into two completely different universes and what it means for anyone holding a broad index fund.
It's a massive divergence.
It really is. So to help you navigate this, we're unpacking 4 critical themes from our daily desk data today. First, we'll break down a pretty severe hawkish shift in the Fed's policy paradigm, explaining exactly why long-term borrowing costs just spiked to pre-Great Financial Crisis levels.
Which is critical. Right. Second, we'll examine that deeply bifurcated historic day in tech equities. We're looking at the massive chasm between Amazon, Microsoft, and Apple.
Yeah, the divergence there it's stark.
Third, we're mapping the cross-currents in hard assets. So looking at why crude oil is surging despite these high rates, while gold suddenly stumbles.
Lots of mechanical reasons there.
Exactly. And finally, we'll synthesize all of this. We're going to map out what this tense equilibrium of high rates, hyper-concentrated equity returns, and persistent inflation signals for the broader market regime.
So if we want to understand the extreme stock-specific chaos we saw today, you really have to start with the bedrock of all asset valuation.
The cost of capital.
Correct. Over the past 24 hours, the global cost of capital experienced a seismic shift. Domestic interest rates moved aggressively higher across the entire curve today.
I mean, looking at the numbers.
Yeah, the 10-year Treasury yield pushed up 6.1 basis points. It settled at 4.74%.
Which is already restrictive.
It is, but the truly significant action happened further out on the curve. The 30-year Treasury yield broke decisively higher, hitting 5.276%.
And we haven't seen that level since, 2007?
Exactly, pre-GFC levels.
Well, looking closely at our latest run of data, that spike isn't just random market noise. It's a direct hawkish repricing.
Right.
We saw 3 specific Fed policymakers, Hammack, Logan, and Kashkari, and they aggressively dissented from the recent rate hold.
They want immediate hikes.
Right, and futures markets absorbed that immediately. They're now pricing in a 71.9% probability of a 25 basis points hike at the September meeting.
And we have to note that rhetoric was completely validated by the macro data.
Yeah, the data was very hot today. The Employment Cost Index, which tracks what employers actually pay for labor, printed at plus 0.9%.
Quarter over quarter.
Right, which beat expectations. And that arrived right alongside a stronger Chicago PMI at 57.6.
Indeed. The Fed is looking at those elevated labor costs, and they're realizing that the final mile of killing inflation is proving highly resistant.
Sticky labor costs mean sticky demand.
Correct. When labor costs stay high, consumer demand stays high, so prices don't fall. But there's this subtle structural paradigm shift happening at the Fed right now.
How so?
Well, they seem increasingly comfortable just stepping back. Instead of actively hiking the overnight policy rate, they are letting the long-end yields do the tightening for them.
Okay, let's use a first principles analogy here so everyone listening can easily visualize this.
Sure.
Think of the bond market as the Fed's outsourced bouncer at a nightclub.
I like that.
Right. So instead of the Fed actively raising the short-term policy rate, which is, like the Fed wading into the crowd to personally break up the party, they just step back to the perimeter.
They let the bouncer handle it.
Exactly. They let the market organically drive up long-term borrowing costs. So mortgages, corporate debt issuance, they all get more expensive. The bond market restricts the economy for them.
Indeed. By allowing that 30-year yield to break out above 5.2%, they naturally tighten financial conditions across the real economy.
Because it raises the hurdle rate for everything.
Correct. If a company wants to build a new facility or fund an acquisition, the cost to borrow that money is suddenly much, much higher.
Which creates a massive headwind for long-duration assets.
Exactly.
Moving to today's data, we have to look across the Pacific too, because international rates are seeing their own intense volatility right now.
Yeah, the Bank of Japan was a major focus today.
Right. So the BOJ held their policy rates steady, but they struck a very hawkish tone regarding underlying price pressures in Japan.
The rhetoric was hawkish, yes, but the actual physical price action in the FX market completely overshadowed the press conference.
Oh, without a doubt. Our desk observed what looks like massive suspected FX intervention today.
Right. We estimate it was around a 6 to 7 trillion yen intervention.
Which is huge.
It is. Basically, a central bank steps into the open market and aggressively buys their own currency to essentially punish short sellers.
And it caused USD/JPY to just plummet.
Yeah, it dropped 3 to 4 large institutional pricing increments in a very short window, dipping well below 158.
Wait, let me push back on the long-term impact of that for a second.
Sure.
Is this a permanent regime shift in Japan or just tactical defense? Because looking at the options market, our desk noted a very rare inversion in front-end yen volatility today.
Yeah, the 1-month implied volatility surged higher than the 3-month.
Right. And to me, that signals panic hedging around a specific event, not the market pricing in some permanent structural change.
Correct. That volatility inversion is the primary tell. When it costs more to buy insurance for the next 30 days than the next 90 days, the institutional consensus is clearly pricing in event-driven risk.
So they're just reacting to the intervention itself.
Exactly. The rate differential between high-yielding U.S. Treasuries and low-yielding Japanese bonds is still incredibly wide. This was engineered defense, not a new structural equilibrium.
Which brings us directly to how these surging rates and shifting liquidity pools are hitting equities.
Because the equity moves today were historic.
They were. With the cost of capital spiking, the market is just ruthlessly punishing any company that can't prove immediate returns.
We are definitely in a market of stocks right now, rather than a broad stock market.
Yeah, the bifurcation today was wild. I mean, Amazon ticker AMZN gained 15.3% after a massive Q2 beat.
Driven mostly by AWS.
Right. AWS revenue was up 37%. And then you have Microsoft ticker MSFT delivering the largest single-session market cap increase in history.
They added $550 billion
in one day.
In one day, because they proved their massive AI capital expenditures are actually generating real Azure revenue right now.
But then on the flip side of that same coin, Apple ticker APL suffered a historic $500 billion wipeout on Friday.
Just a brutal sell-off.
Yeah, they had soft guidance and a notable services miss. It just shows how little mercy the market has right now.
On that point, this extreme divergence is happening globally. Over in Asia today, the Kospi index posted a record 17.9% single-day gain.
Which is its largest advance this century, right?
Yeah, correct. And that was heavily driven by SK Hynix, which surged roughly 25% today.
A 25% move for a major semiconductor manufacturer is just huge.
It is. It completely erased the heavy institutional selling they saw earlier in the week.
Well, on that point, we really need to dive into the aggressive flow data from today's proprietary updates.
The flow mechanics explain a lot of this action.
They do. Because earlier this week, we tracked the largest 3-day hedge fund capitulation since November 2022.
A total systemic washout.
Yes, systematic leverage was wiped out. U.S. levered ETFs shed $60 billion in assets.
Margin calls everywhere.
Exactly, so forced selling. But today's institutional consensus shows extreme short covering in macro products and a fundamental regrossing in infotech.
Right. When you force everyone to sell, eventually there's no one left but buyers.
So they realized Amazon and Microsoft's CapEx is actually generating returns.
But wait, I have a question on the data deck here.
Go ahead. There's a striking statistic. Hedge fund allocation to the Magnificent Seven dropped from over 20% down to just 15 or 16%.
Yeah, they de-risked heavily.
So is today's buying a genuine fundamental belief in the AI hardware trade? Or is this just mechanical short covering after a brutal deleveraging earlier this week?
It's a synthesis of both. But that low aggregate allocation tells you institutions are exercising extreme selectivity.
So they aren't just buying everything.
Correct. The initial spike was mechanical short covering, but the targeted buying in Microsoft and Amazon is fundamental.
They're stripping out the losers.
Indeed. They are abandoning broad tech exposure and concentrating capital strictly in proven free cash flow positive winners.
Which makes sense. And that intense focus on tangible reality bridges us perfectly to our next theme, which is commodities and hard assets.
Right.
Because of the persistent inflation that's keeping rates high, what we talked about in Block 1, is deeply tied to the physical energy markets holding firm.
Moving to today's data in the physical markets, we see supply-side fundamentals completely ignoring those higher interest rates.
Yeah, WTI crude surged 3.38% today, hitting $86.80 a barrel.
And refined products were even stronger.
Exactly. European diesel wholesale margins hit an all-time high of $65 per barrel.
Which is a massive headwind for disinflation.
Right, because diesel fuels the entire global logistics chain.
Right.
But why are we seeing that specific bottleneck, especially when a 5.2% 30-year yield is supposed to be destroying economic demand?
It comes down to severe, localized supply constraints. Global refinery runs are being significantly reduced right now.
Due to maintenance and geopolitical issues, right?
Correct. The physical market is so tight that it's just completely shrugging off the higher cost of capital. Supply is simply lower than baseline demand.
But interestingly, when we look at today's precious metals data, we see a completely different reaction.
Yeah, precious metals struggled.
Gold dropped 1.4% to $4,046.15 an ounce, and silver fell 2.36%.
The divergence there is notable.
Right. I mean, let me challenge this. If we're seeing extreme equity volatility, an Apple wipeout, suspected BOJ interventions, and a hawkish Fed, shouldn't gold be catching a massive safe haven bid?
You would think so historically.
Yeah. This sell-off suggests the market is repricing yield, not panicking over systemic risk.
That is an accurate read. The sell-off in gold is a direct mathematical consequence of the real yield spike we discussed earlier.
Right, the TPS yield.
Correct. The 10-year TPS real yield is sitting at a highly restrictive 2.45%.
So that's your return after inflation.
Exactly. And gold doesn't pay a dividend.
Right.
So when the risk-free, inflation-adjusted return on a government bond guarantees you 2.45%, holding a non-yielding asset like gold becomes very expensive. Institutional capital just runs a spreadsheet and locks in the fixed income.
Understood. All right, let's pull all these threads together to define the current market regime for you.
It's a complex picture.
It is. We have 5.2% 30-year yields, we have hyper-concentrated tech mega-cap wins, and we have $86 oil.
Right.
What do all these simultaneous moves suggest about the broader economic environment we're navigating?
When you synthesize our daily desk data, it defines a very specific equilibrium. We are essentially in a soft landing with persistent inflation regime.
Okay, meaning no deep recession, but inflation stays sticky.
Correct. And the proof is under the surface. The rate-sensitive Russell 2000 index fell 0.50% today, struggling with those borrowing costs.
But credit markets are fine.
Indeed. High-yield credit spreads remain completely calm. The CDX high-yield index is at just 312 basis points.
So the bond market isn't pricing in bankruptcies.
No, it's just pricing in a higher-for-longer reality.
Bringing this back to your portfolio.
Yeah.
In a world where the S&P 500 correlation is at a near all-time low of 0.1, broad index investing is really masking some massive turbulence.
It is. A correlation of 0.1 means stocks are moving almost completely independently.
Exactly. The market is exclusively rewarding companies with demonstrable free cash flow, like Microsoft, that can self-fund their AI ambitions without relying on this expensive debt.
On that point, I want to leave you with a forward-looking concept pulled from our desk research today.
Let's hear it.
The battle for data sovereignty.
Okay.
Right now, the market rewards massive cloud providers building generalist AI models. But as AI inference costs plummet, those massive generalist models may just become commoditized.
Oh, like basic cloud storage.
Exactly. So the true future enterprise value might actually lie in companies deploying hundreds of small, hyper-focused models on proprietary, localized hardware.
Because enterprises won't want to upload sensitive IP to a public cloud.
Correct. And if that shift happens, it completely changes the definition of the AI infrastructure trade moving forward.
That is a massive structural shift to watch.
All right, quick recap. A hawkish Fed shift drove long rates to multi-year highs, forcing a ruthless bifurcation in equities where only proven AI monetizers like Amazon and Microsoft thrived, all while firm oil prices cap any hopes of rapid disinflation.
It's a highly selective market right now.
It truly is. Thank you for listening to Market Pulse by Orestes Capital. We're Alana and Marcus. We'll be back next week with the latest market color. Have a great weekend.